This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Alex's picture saying, looking for the downloads. Now, Eric, let's dive into crude oil, starting with the EIA inventory.
EIA printed a massive drawdown of 6.4 million barrels. Cushing, Oklahoma drawing down 659,000 barrels. Gasoline drawing down 634,000 barrels. The lone build on the board was distillates at plus 1.6 million barrels for a net petroleum drawdown of 5.4 million barrels, with U.S. production holding unchanged at 13.1 million barrels. Crude oil is consolidating as everyone wonders whether geopolitical escalation between Israel and Iran is already over or if it's only just begun. In my opinion, Israel wants to escalate and wants to escalate very badly. So what happens next depends primarily on the extent to which Biden is willing to support and effectively to allow that escalation from Israel. My sense is that Biden has already decided that he wants to wait until after the U.S. election before the United States starts a war with Iran. And he's probably made a deal with Benjamin Netanyahu already saying, look, just hold your pants until we get to the election. After that, we'll let you do anything you want. But it remains to be seen what happens between now and the election and whether or not we can get there before some escalation happens on its own.
Eric, the much-anticipated consolidation has finally happened. Obviously, geopolitics with a huge overhang is going to put a floor under oil. And so now that we've consolidated down to the 50-day moving average, it's a very interesting place to be watching whether or not oil establishes a short-term swing low that can bot on dip. Generally, I think that if oil can stay on a sustained basis north of $80, that this is the kind of a pullback that should be bought. And I don't see any reason why we can't see oil get back up toward the highs from last year in the mid-90s as we move forward. Nonetheless, let's move on to equities. I want to get Nick involved in the conversation. Nick, what levels are you watching here on the S&P?
Yeah, Patrick. So right now, the SPX spot price is approximately 50.40. We have an implied move for the May 17th monthly OPEX of plus minus 140 points. Therefore, the upper implied move is 51.80 and the lower implied move is 4900. Right now, we have key resistance at 5100 and key support at 5000. As I mentioned in prior weeks, I'm inclined to think we see a test of the previous all-time highs from January of 2022 around that 48.20 mark on SPX. So I do think we have some downside left in the short term. Although I am bullish on certain names, I'm being cautiously optimistic right now.
Yeah, what I find interesting, on page 4, I put the chart of the S&P 500 with the 50-day moving average on there. And what's interesting is that it's been a very good arbiter of trend, which is that when on a sustained basis, it's above the 50-day moving average. It's a clear bull trend. And the turning below the 50-day moving average has obviously marked many of the corrective phases. We, very similar to all the downturns through 2022 and 23 that are visible on this chart, some sort of multi-month corrections often happen in this state. With the fact that we've rallied up towards this 50-day moving average and rejected it, and obviously earnings were going to play a huge role, the corrective or downside window is still open, and 4,800 and 4,700 are all realistic downside targets that would put this into that 10% market correction category. It's really about next week. I mean, not only do we have the pig in the python moment of all the corporate earnings, and I think that Mag 7s are going to play an important important role in deciding the short-term trend. But we also have the FOMC meeting and the jobs numbers. And so plenty of news that could drive volatility in both directions. And so it will be a bumpy ride, but the downside window still remains open for the short-term correction. Let's move on to the Nasdaq. What are you watching on the Qs?
Yeah, so right now in Qs, the spot price is approximately 422. We have an implied move for the May 17th monthly OPEX of plus minus 16 points. Therefore, we have an upper implied move of 438 and a lower implied move of 406. Right now, we have key resistance at 435 and key support at around 413. I'm inclined to think we see a move lower toward that 400 level, which would mark a top to bottom move of around 11%. As you mentioned, the Mag 7 are going to be the ones to kind of dictate where we move. We saw Tesla miss on the top and bottom. However, they actually popped on earnings. And we saw Meta last night report higher expected CapEx for next year, as well as lowered guidance, which caused them to fall about 15% overall. So right now I'm being cautious, but I'm holding Apple and Google in my own portfolio. And I'm waiting to see what happens with the other big names, because I do think we test that 400 mark out in the short term.
All right, Nick, let's move on to the volatility index, because Friday's OPEX drop that we had that caused a little bit of fear to come into the market saw the VIX pop into the 20 handle on the short term. That solidified at least a swing low that spurred the rally of the last few days. And we really now have seen the VIX come right back down off of that high, but it really does feel like we've now entered a new higher volatility state in the market. The 12 to 15 range that has more or less contained the volatility index throughout the last 4 or 5 months has now been decisively broken. It'll be really interesting to see whether or not we get back up into the 20s during this market correction on a sustained basis. What are you watching there on the VIX?
Yeah, Patrick. So with the VIX at around 16, we can expect intraday top-to-bottom moves on SPX of about 1%. What we're seeing now is that volatility is no longer cheap, insurance is no longer cheap, and market participants are now chasing that premium. I think we're going to see perhaps another pop toward that 20 mark, which we saw last week. The highest level we saw was 19, which was the highest we've seen volatility spike since last November overall. So it's been a few months since volatility has been that high. Overall, I'd be cautious in terms of remaining long in the market on short-term positions. And if you are long in your portfolios, insurance is not a bad idea overall right here.
Well, the one thing to take away is that during market corrections, overall volatility in both directions always accelerates. And so, getting used to the idea of 57 to 70 S&P point swings on a day in, day out basis is actually quite normal. And it's almost like climatizing to that higher volatility.
Absolutely, I agree. And moving on to the dollar index on page 7. Eric, what are your thoughts here?
The most important news for the dollar this week was completely ignored by markets. That news was the U.S. House of Representatives vote in favor of the extrajudicial payment of seized Russian foreign reserve assets to Ukraine, which Senator Rand Paul correctly characterized as an act of war. It's important to separate whatever views you may have about Russia from the question of whether or not the United States will remain credible in the eyes of other nations' central banks as a custodian of central bank reserve assets. The United States just completely abandoned the rule of law and made an extrajudicial political decision to award one nation's foreign reserve assets to that nation's enemy. This plays perfectly into Vladimir Putin and Xi Jinping's longer-term agendas perfectly and will only help both of them to persuade other nations around the world to abandon the U.S. dollar as the world's global reserve currency. The consequences of loss of reserve currency status for the U.S. government's ability to continue its pattern of deficit spending cannot be overstated, and almost nobody seems to be paying attention to these consequences. This is a profoundly bearish sign for the U.S. dollar in the long term and will ultimately accelerate the schedule for Luke Gromen's predictions of the U.S. dollar losing its reserve currency status coming to fruition. But for now, U.S. financial markets are completely ignoring this important long-term fundamental signal. What the market is responding to is collapsing expectations of a campaign of several rate cuts later this year and increasing expectations of the possibility of further rate hikes if inflation continues to run hot. So if Jim Bianco is proven right that inflation has already bottomed, I see plenty of room for the Dixie to move considerably higher in the near term for all the reasons our friend Brent Johnson has predicted before other nations eventually take decisive action to ditch the dollar as reserve currency, which will ultimately prove to be ultra bearish for the dollar, but not yet. But just as Brent has said himself many times before, I think the U.S. dollar is much more likely to move higher for now. The true consequences of the U.S. government's abdication of the rule of law won't be felt for some time to come.
Yeah, Eric, it really does feel like the U.S. dollar index has entered some sort of a new bull phase, but it does have a couple of key obstacles here that may on the short term, have the dollar bumping its head along some resistance. Now, not only are we approached the 2023 highs around the 107 level, but one of the key currencies that the U.S. dollar has been strengthening against has been the U.S. dollar yen, and I have that on page 8, and our techniques, the measured moves are complete. And with us going into the Bank of Japan meeting, it'll be interesting to see whether or not we see a correction start in the U.S. dollar against that yen after such an extraordinary move. And so maybe on the short term, the dollar may be far more volatile without any directional trend, but I still think it resolves itself bullishly. We'll be watching whether that 107 level can be beaten.
Moving on to page 9, we have that gold futures chart, which is off highs right now. What are you guys thinking here?
The big correction in gold was easy to see coming and resulted from the non-re-escalation of geopolitical conflict between Israel and Iran. My prediction is that the U.S. will eventually enter this conflict in a direct hot war conflict with Iran, but that President Biden will do everything humanly possible to delay that outcome until after the November elections. The House of Representatives' reckless extrajudicial seizure of one nation's reserve assets and giving them to their enemy will ultimately be extremely bullish for gold because it will incentivize other central banks around the world to accelerate the pace of their gold buying in preparation for abandoning the dollar as global reserve currency. But for now, geopolitical conflict premium and whether the Fed resumes a rate hiking cycle are likely to be the primary short-term determinants of gold's price action. This correction could easily go another $100 to the downside if rate hikes are back on the table and tensions between Israel and Iran can be kept on hold until after the election. Or we could see the exact opposite and go back to new all-time highs overnight if the U.S. enters a direct military conflict with Iran. I remain confident that the long-term bull market in gold still has a lot farther to go to the upside. The question is only of how deep of a correction we'll see before it's time to buy the dip, and there's plenty of room for news flow to push the market hard in one direction or the other.
Well, Eric, I totally get the case for the bigger picture gold bull market being underway. But to me, I'm just looking at it purely technically. And on the short term, this has been one of the most extraordinary bull impulses that gold has had in a long time, in many years. And the question really is, can the bulls maintain this momentum? And one of the big tells is about how deep and how far market corrections go. A full Fibonacci retracement of this bull advance could see us trading down to that 50-day moving average around 2250 or 2200. But if the bulls are decisively in control of this trend, then the correction should be very shallow and very well defended. And so if the price action can decisively stay north of 2300 here in the coming week or more, especially once we get through all of that news next week, that actually may make a case for another immediate bull leg higher, which could see 2500 on the upside.
Moving on to our final slide of page 10, we have that uranium chart. Eric, I'm always interested in hearing your thoughts.
There's been a whole new round of political rhetoric from the White House about the need to break our dependence on Russian uranium imports. I think this talk from the White House is a likely catalyst for the passage of the Senate bill already pending that would ban Russian uranium imports. When that bill passes in the Senate, it's likely to be a strong bullish catalyst for both uranium and uranium miners. But for now, the market is still consolidating, with almost no price movement in uranium itself until yesterday when we were down 3%, and still plenty of opportunity to buy many of the best uranium mining shares just above their lows from over a month ago when the correction may have bottomed, or who knows, maybe we still have one more leg lower. We'll see what happens.
Yeah, the bull case for uranium is still very strong, but the price action on the short term is continuing to show some consolidation. Every time the Sprott Physical Uranium Trust tries to rally, this spot uranium simply doesn't react and the selling comes right back in. It's a very heavy chart on the very short term, and there could certainly be one more corrective leg that could see a 5 to 10% drop in uranium on the pullback. But it certainly, in my mind, will be an extraordinary buy on dip if it does give that kind of a pullback. Right now, we're in some sort of a corrective phase. It may be over soon, and it will be very likely a great buying opportunity. But right now, in the short term, a bull breakout is not yet really started.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.